Hello, everyone, and welcome to TradeFinder Live. My name is Zach. I'm one of the team here at Elliott Options, and I'll be facilitating this session tonight with our speaker, Rob Roy. I'll introduce Rob here in just a few moments, but first we need to cover off a few important details about the session. First and foremost, this is our live disclosure disclaimer agreement. If you've attended any of our live sessions previously, whether it be a TradeFinder Live or Insiders meeting, and you've seen this, the main thing to take away from it is that we are not licensed investment advisors in the United States, so nothing is to be taken as personal investment advice. We do have this available on our website to be read in full detail there, or feel free to take a screenshot if you like, but that's the main point to take away. So for this session, we actually only have one method of asking questions, and that's going to be circled on the screen there for you. That the Q&A window is the only method for this session. And at any point throughout the session, please feel encouraged to type in a question. Just know that the question portion is brief at the end. Rob opens it up to a few questions from both Zoom and YouTube. So we'll try to get to it if we can, but with time constraints, it is brief. With that being said, just know if we don't get to your question, it has nothing to do with the validity. We just only have so much time. And if we also don't get to your question, be sure to attend the Insiders meeting when there's 45 minutes focused on answering questions. So much higher likelihood of getting your question addressed there. And we'd love to see everyone on and have that interaction. Lastly, we have the chat window as well. That's for all attendees to interact amongst each other, and for any support related queries, I can handle it there as well. Just know that Rob only addresses questions from the Q&A window. So if you want your question to be possibly taken, be sure to leave it in that window. Other than that, I think that covers off all the important details. So at this moment in time, I'll introduce Rob Roy.
Thanks, Zach. Hi, everyone. Welcome to TradeFinder Live. If this is your first time joining us at TradeFinder, welcome. If you've been here before, obviously, welcome to you as well. As we go through TradeFinder, if you are new, we go through the market outlook. It says U.S. market, but we cover off some of the international markets as well. And if you're only interested in trading the U.S. market, please don't tune out when we look at a few of the international markets, because all these securities are tradable on the U.S. exchanges, and you might find a pattern that you want to trade being another country's market. Then we'll look at some of closed trade alerts that we've sent out for our alert subscribers at Elliott Options at ewotrader.com. We'll go through and then review the case study considerations that we've looked at past trade finders, and we'll see if we can find a case study consideration for tonight moving forward. And as Zach said, with whatever time is left at the end, we open it up to a live Q&A, and we invite you to ask your questions. We'll get to as many of them as we can in the time allotted. And so I don't waste any more of that valuable time. Let's go ahead and look at the charts. Just double check and make sure that you're seeing the same chart that I'm showing. So here's the market. And I wrote this note to our alert subscribers. I can post notes. We do a meeting every Thursday night for our alert subscribers. We call that the Insiders meeting. And in between that, I can post comments on the website to communicate with them. They also have the ability to send emails directly to me at any time if they'd like to do that as well. So a lot of access back and forth. But here's what I posted yesterday. On the low, as you can see, we were a bit away from that 10-day moving average. And if you've watched any of these recordings that I've done in the past, you know the phrase, no security in any time frame gets very far away from the 10-day moving average. And then we rallied into the close yesterday, and that's because at the low, we had that separation. We had a little bit of follow through today, nothing too significant, as we are moving back up to test 420. 420 was support for quite a while. You can see we kind of churned here for about a week. We did break below it, and now we've turned and gone back, and now we're testing to see if 420 will indeed act as resistance, or can we break back above 420 and call this a false breakout. A lot's going to depend on tomorrow. Big day tomorrow, probably one of the most watched Fed meetings in a very long time. So right now the markets have priced in about a 50 basis point rate hike, and the Federal Reserve talking about lowering their balance sheet, excuse me, to the tune of, yeah, this is one to choke on. $95 billion per month is what they're talking about, reducing their balance sheet. I think that's going to take some liquidity out of the market. I think it will. How seriously will it affect the market? We'll see. I feel like we're probably entering into a bit of a bear market phase. hard to see the market overcoming that significantly. Can we move back to the upside? Yeah, perhaps, but nothing like what we saw last year or coming off of the COVID lows either. It's going to be a struggle when the Federal Reserve is raising rates and withdrawing liquidity at the same time. It's just a very difficult market. So if the Federal Reserve, and there has been rumors, but I don't think this happens, of a 75 basis point rate hike, then I think the market sells hard on that, because if there's going to be one, nobody really expects it to be at the first meeting, maybe over the summer, depending on how things go, but don't really expect to see that. So that would be a bit of a shocker. And again, I think we have a pretty significant sell-off if that happens in the markets. Now, there's also some commentary out there where people are thinking, well, we just had the first quarter GDP. We went down 1.4%. So we're halfway towards an official recession. Perhaps with that lower economic news, the Federal Reserve won't be quite so hawkish as they've been. Maybe there's a slight bit more dovish. Maybe even they only cut 25 basis point at this next meeting and signal a bunch of 25 basis point rate hikes. I don't think that's likely either. So I don't think either one of the extremes is likely. I think the Federal Reserve is going to toe the line. They're going to raise 50 basis points and they're going to announce their balance sheet reduction. So how does the market react to that? Well, that's the great unknown, isn't it? I'm not sure. We'll have to wait and see, especially with a market that's right at a support resistance area with the Federal Reserve about to make such an important announcement. Now, as you know, we still have the big zigzag pattern to the downside that takes us down right where this wave 5 is, right around the 400 level, potentially down to 392. And you can see the top of the wave 5 is at 393. So we have two different Elliott wave Fibonacci patterns giving us roughly the same target. And so here is that big zigzag pattern. And there you can see right down at the very top of the wave 5 tap box, which stands for time and price projection, if you're wondering why it's called a tap box. So that would be an area where the market could look for support. If it doesn't find support, then it starts getting pretty ugly. If we start to look to see 161.8% extension to the downside, but we're a long way from that. We haven't even hit the 100% extension yet. And as I said, a lot depends on what happens tomorrow. So could we get a short-term rally? We could. I think the most bullish thing for people to hang their hats on that want to see the market move back to the upside is the fact that we are starting, although it's not extensive, but we're starting to get some separation between the 10 and the 50-day moving averages, a la what happened over here. When they start to separate, see, the 10-day separated from the 50 here, and what happened? We rallied up, and then we came down, 10 days separated again, we rallied up. So we're starting to get that separation. So we could get a bit of a short-term rally in here before anything significant happens to the downside. So does the Federal Reserve exacerbate that by being a bit more dovish? They certainly would, but I would submit that even if they just go status quo, there could be a little bit of a relief rally that they didn't go 75 basis point, that they weren't more hawkish, knowing that the economy is weakening. So either scenario, we could see a little bit of a bounce here due to the fact that there's that separation between the 10 and the 50-day. And again, all you have to do is look at history. That's what technical analysis is, right? We look at what happened historically, and then we draw a conclusion on what's likely to happen based on what we know as a fact has already happened. So we don't trade on what we think is going to happen. We trade on the best information that we have. So that's pretty much it for the S&P. We can take a look at volume if you wanted to see that. Note that today, much lower volume than yesterday. But yesterday we had early selling and then we had a big reversal. So that higher than average volume was a combination of both selling and the rally. And then today, really not much going on in the terms of volume. And I think that's just kind of a lot of, all right, let's wait and see what can happen from this Fed meeting. Everybody knows the things that I just gave you. Those aren't any massive pearls of wisdom. That's really what everybody is watching. Do they surprise either direction, or do they just come in with what the market expects and what the market has already priced in? And I think that's the likely scenario. You've heard a couple of the Fed governors saying they think they need to shock the market. Well, just the mention of the 75 basis point rate hike potential was a pretty good shock to the market. So I think just that accomplished its goal. And sometimes the Federal Reserve does that. Sometimes they just chat and try to gain their points that way. All right, so let's look at some of the other markets. Looking at the Dow, which had been doing a bit better than some of the other markets. We'll see how that looks when the chart comes up. There we are. And you can see that the Dow is at support. It hasn't broken it like the S&P did. The S&P broke below that support level at 420, but the diamonds are still there with a doji. Isn't that interesting to see what happens tomorrow with the chart here right at a support level with a doji? Could that be telegraphing perhaps a bit of a rally tomorrow? Maybe. We'll see. Again, I still think the market's head lower. I think that the selling isn't done yet. In the last SPY update, if you're watching that, and if you're live streaming on YouTube and you haven't been to our YouTube channel, you can go to YouTube and look at that last video where I talked about how expect panic and a really ugly day. And just to be clear, I wasn't talking about that occurring yesterday on Monday. I was talking about before the selling ends. Before the selling is over and we've put a bottom in, I think we have a real panic day. We have a real nasty day in the markets with a big spike in the VIX, higher than 35. I just don't think that's a high enough VIX to put a real bottom in the market. So we're working our way down. We broke below support on the S&P. We haven't here yet. So if we get a little bit of a rally here, I think we're just setting up more downside. I really do. And that the selling isn't fully over until that occurs. That ugly day, massive down day, kind of a 1,000-point day like we just saw on Friday but with a bigger spike in the VIX. Maybe it even has to be a worse day than that. But pretty interesting that the diamonds are sitting here still on top of support with a doji. They also in a wave 5 impulse pattern to the downside. So we still could go lower here on the diamonds. But let's take a look at the Qs, which is, to me, had been one of the best charts out there, nearing their wave 5 target. Broke below the support level here at 320. And again, let me take that line away. Look at that, a perfect doji right on. You think everybody's waiting to see what is the Federal Reserve going to do tomorrow? It's doji day. Every now and then we get those. I call them doji days when there's so many different markets that are showing dojis. So here we are. We broke 320. Now we're back up testing it. So very similar to the SPY chart. The Dow chart being a little bit better, getting back close to that 10-day moving average. So we're sitting just right here at this area that was support is now resistance, but right on top of it with a perfect doji. I think something's going to happen tomorrow. Regardless of what the Federal Reserve does, I think the market makes some sort of a significant move. I don't know if it's a bounce up. I don't know if it's a sell-off. And just remember, here's a point, that what happens tomorrow after the Fed meeting usually gets retraced. So normally we get some sort of a movement right on the Fed announcement, and then that movement gets retraced. It's very similar to breaking out of one of our corrective triangles that we talk about in our volatility portfolio all the time. Is when you break out of a triangle, at some point that breakout gets retraced. Might be immediate, might be down the road, but with the Federal Reserve announcement, it's usually within the next day. So if you get a big move following the announcement, sometimes it gets retraced before the end of the day. Sometimes it's the next day, but it very rarely goes past that. So be real careful. We've been light on our alerts at the beginning of this week, and that was part of the commentary that I sent to our alert subscribers. And that's the reason why. Big Fed meeting coming up tomorrow. And what happens immediately after that, don't get caught up in jumping the gun and go right into placing directional trades. Let it settle out. Give it a day. So see if that whatever happens on the announcement doesn't get retraced and settle in. Then you have a better idea of where the market's going from here. And then you can go ahead and put on some sort of directional trades. Looking at the IWM, and we noticed that we talked about this last week. We had broken below 190. We talked about it over the weekend in that SPY update on YouTube. And so now we're back testing that again. So every market is right around support resistance. It's just all of them but the Dow broke support and are now testing it as resistance. The Dow didn't really break it. It's just sitting on top of it. So very similar through all of the different markets. And we have this big trading range here between 190 and 210. Heavy put buying on the IWM last week towards the end of the week. So there's some big bets that the IWM is going to go lower. We'll see. We'll see if that plays out or if we get some sort of a rally on the news tomorrow. Bitcoin. Taking a look at the chart there, just not a whole lot going on. I talked about this a while ago of this halving that occurs not till the end of next year, and that you're probably not going to see a whole lot of movement out of Bitcoin between now and then. And it's kind of been that way. We're just been in this big trading range here, maybe a little bit of a triangle here. And you can see what happened. This is a perfect example of what I was just talking about as far as how breakouts of triangles get retraced. There we had a breakout, and what happened? Right back down. And now we've just been consolidating right at the point of that breakout, right in the 40,000 area. We've broken below that. So I wouldn't be surprised if we come down and test 36,000. I think that's likely as we're just hovering here. Look at this area here where 40,000 just recently, forget going back a couple months, just recently 40,000 holding a support and broke it. Now it's resistance. So 40,000 is the key level right now on Bitcoin, but we are meandering down a little bit. Again, I think we test 36,000, but there's a lot of support there as well. But nothing real major going on with Bitcoin, which is pretty amazing. Now, I know some of you have asked to show the EWA instead of the XJO, but I'm going to show you this because it's the actual market, and then we'll show the EWA because that's more tradable. But look what's occurring again in Australia. Now we're going through and forming another triangle. So Australia has been acting an awful lot like how gold used to act. The GLD would form a triangle, break out, form a triangle, break out. And those tendencies don't last forever. So when you see them, just don't think, okay, that security always does that. They go through periods of time, and that's what's occurred with the Aussie market. See, there's another triangle right here. So I can illustrate them for you. There was a triangle, and then the big massive breakout. What happened? Another triangle right here, massive breakout, but the opposite direction. And so this breakout did the retracement of the original breakout. Pretty cool the way that worked, isn't it? And now what's happened? So now we're back up at resistance here, and we're forming another triangle. So the Aussie market's getting ready to break out. Which direction? Who knows? We've retraced the what needed to be done, although you could make an argument that we haven't fully retraced this lower triangle yet. So perhaps we get a downside breakout there. We'll have to wait and see. But let me go ahead and show you the EWA, since a lot of you have asked about it, as it's a bit more tradable. And you can see there that down here around, notice kind of the difference in the charts there. Instead of a symmetrical triangle, contracting triangle, we have an expanding triangle. So illustrating consolidation nonetheless, but in the opposite manner, where the XJO is showing you a contracting triangle and the EWA is showing you an expanding triangle, which is basically just you flip the triangle the other way. The point's on the left-hand side and the mouth is out on the right-hand side. And we've got a wave 4 right on top of support there at 24. So if you want to trade the EWA, 24 is your stop. If you wanted to go long, if you want to take a shot at this breaking to the upside and fulfilling this wave 5 impulse pattern higher, then if it breaks below 24, you're out. That would be the move there on trading that. And then the same thing here. I wanted to show you the Nifty because it's got such a great triangle, but I'll show you the INDA too because y'all ask about it. So we'll take a look at this triangle is still there. It's in a wave 5 impulse pattern to the downside. And Elliott would tell you because of that, we're likely to get downside breakout. Notice the major moving averages all converging there in the same area. But look at this big triangle here. So India is going to break out at some point in time. So we had this doji after Friday, and we thought, okay, we showed that over the weekend in the SPY update. We're getting ready to move. No, we didn't. Little gap down, right back up, right back into the point of the triangle. Pretty interesting stuff there on the Nifty. So here's the INDA and a little more normal with what's going on in the market. I would suggest or submit to you that this is more of a descending triangle rather than a symmetrical one that you saw on the Nifty, because there's a lot of support there at 44. If it breaks below it, easy move here. If it breaks below it, we're coming down here to test 40. Why? Because there is nothing in the way. We had a big bounce off of 40 right up above 44. So if we break below 44, there's nothing to stop it. There's no support on the way. So if we break below on this descending triangle, now remember, and I've talked about this before, just because it's a descending triangle does not mean it's likely to break to the downside. There's people out there that market that because it's easily marketable. Hey, if you have a descending triangle, you're going to break lower. Yeah, ascending triangle, you're going to break higher. No, the data does not show that. That's marketing. The data shows that any triangle, ascending, descending, or symmetrical, can break either direction, and the numbers are about the same. So this could break to the upside as easily as break to the downside. But if it does break lower, we are coming down to 40 because that's where support is. And if it breaks higher, you're going to run into a little bit of support there around 46 here, a little resistance, I should say, a little resistance around 46. And if it can get through that, then there's more up there around 48.5. So if you're trading those markets, and then the DAX, which has just been so much fun to show. You've heard me talk about it over and over again because it's just following Elliott wave for the past 2 years. Basically, it's been in a full-on Elliott wave pattern that has hit its target time after time after time. And so looking at the DAX moving to the downside here, a little bit of support is trying to hold here at this 25 area. Doji yesterday, kind of a weird one today. And if it breaks below that, it might try to hold there at just under 25. Maybe some longs come in, because if you break below there, everybody can see what happens. If it doesn't hold there, if we don't make a double bottom, if you will, then we're coming down to hit this wave 5 target, which, remember, that wave 5 relabeled to a 3 times. So 3 targets have already been hit on a wave 5 on the way down on the DAX. And looks like we're trying to continue down to here again, but it is making an effort there to hold at 26. So you have to respect that and see if it can continue to hold that. Let's look at interest rates. Man, am I surprised at the way interest rates have held in there, even with the selling that we had on Friday, and then a little bit of follow through in the early part of the day yesterday. No major money moving into the bond market, fleeing the equities market. Interest rates are just powering up, or perhaps there is a lot of money moving in there and interest rates are moving at such a strong clip that it doesn't matter. They're going higher. It's amazing to me that we have had this kind of a vertical move for this long. Now, it's not perfectly vertical, but it's a lot more vertical than the 45 degrees that usually holds on a move like this, where you have these small corrections. I mean, this is acting exactly like what happens on a 45-degree angle move. So if you've heard me talk about this, why I like trending moves to be in a 45-degree angle, and when the market starts trending again, whether we're starting a new trend to the downside or the upside, we'll look at that a lot with our impulse trades or directional trades, because when you find those patterns, they're great to trade, because a corrective move when you're trending in a 45-degree angle are smaller. Like this, you don't get big corrective moves when you're trending in a 45-degree angle. You would expect there to be more significant corrections in a move that's this vertical, and it hasn't happened. As I said, it's playing right as if it was a 45-degree angle. And so that's surprising to me. I've been around for over 25 years trading options, so it takes a lot to surprise me. You see things all the time that you're not aware of, and you learn all the time. You constantly learn, but to actually surprise me takes a lot. but this is one of those things that has a doji there. Maybe we get some sort of a big correction in rates. Maybe the Federal Reserve does surprise everybody and comes out and they're a little more dovish than expected. And that could create a big move down in rates. But we hit 3% on the 10-year and it didn't phase it at all. I thought that could be a point. You've heard me talk about that in some of the recordings. That could be a point where the market made a corrective move. Nope, didn't happen. Just 3%. Okay, that's what's next. Well, that's kind of how interest rates are acting. But at some point, you would think that there has to be a bit of a correction. And I say that not because of where the rates are from the 10-day moving average. You can see we're really not that overbought. But here's that separation. And I talked about this. This is just as strong a rule as no security in any time frame gets very far away from the 10-day moving average. The 10-day and the 50-day don't separate significantly for very long either. Now, here's a scary scenario. What if the equities markets just flat out tank? And that's where money leaves the equities market and goes into the bond market. And there's such a flood of money coming into the bond market that pushes rates down. Because remember, prices and yields move in opposite direction. So if money is moving into the bond market significantly, prices go up, rates come down. Something is going to create a correction here in rates. Is it the Federal Reserve being really, really dovish and surprising people? Possibly. I don't think it's likely, but it's a possibility. And that's what we do here is we discuss possibilities of what could happen so that you're prepared no matter what happens. We're not trying to say this is definitely happening. You don't ever say that because nobody knows. You trade according to what the market is telling you. And so we're trying to give you scenarios based on what the market is suggesting could happen. And then you need to listen to the market and follow along. Don't trade by what you think is going to happen. Don't trade by if I make a comment of what I think is going to happen. Don't trade on that either. Trade on what the market's telling you. And from history, from technical analysis, this doesn't happen for very long. And at some point, they're going to come back together. Now, either rates go dead sideways for a while and they come together. So it doesn't have to be a big correction in rates, but there has to be some sort of consolidation. So if it's not a correction in rates, it has to be a lengthy consolidation, which will allow the 50-day to catch back up and the 50-day and the 10-day to come together. One of those two things is going to happen. I'm telling you, we'll come back and look at this in a couple months and you'll see that the 10-day and the 50-day are closer together. I don't know which scenario plays out, which one creates that, but they're going to get back together. See all this stuff here? Look what happened last time. There's a little bit of separation. It wasn't as big of separation as we have now. And what happened? Came back down. The 10-day and the 50-day got back together. Why? Because there was an extended consolidation in rates. That can happen again. Maybe that's what occurs, that we hit 3% and the 10-year just pegs there for a while and allows the 10-day to catch up, and then we consolidate here. So there's a perfect example of the second scenario that I gave you that could occur. The first one would be, this is not really as significant, but you can see here we had a pretty vertical move up and rates made a pretty significant correction. And the 10-day and the 50-day came back together a little bit before taking off again. So a couple examples there of the scenario that I just went through of what could happen with rates, but I think that that's going to have a lot to do with what occurs in the markets, which is why I'm spending so much time on it. And the dollar, wow, this vertical move up, now that's vertical. Okay, I could argue that the 10-day moving average or the 10-year on rates has moved a bit more vertical than normal, but not super vertical. Well, that's as vertical as it gets right there on the dollar. Just boom, straight up. No correction, just a sideways consolidation. That's amazing to me that we're just consolidating here in the dollar rather than any sort of correction. And that could all change tomorrow as well with how the market perceives what the Federal Reserve does and says. Now, remember, what they do is going to be part of what's watched. And then what they say is the second part of what's watched. Are they going to telegraph what they're going to be doing down the road? Most people think they will. And so what they do, again, is one hand, what they say is coming is on the other. And so perhaps we get some sort of a movement in the dollar. Again, I like the dollar staying strong. I'm a fan of the big dollar. but we don't want to go in too strong because it indicates too much global weakness. And then the other thing is it makes it really difficult for companies that have international ties, international commerce from US based companies. It's very difficult when the dollar is this strong. So perhaps that's all we get. We are in a wave 3. There'll be a wave 4 at some point in time. That could be well down the road, who knows, or it could start soon. But I'm pretty surprised that we've gone sideways there. So a couple things that have been a bit surprising, but we're in unusual times, aren't we? We've not been in a point where we were entering into a recession where the Federal Reserve was just embarking on a rate hike campaign. And I don't think I can overstate that. Normally, recessions are caused because the Federal Reserve has gone on to a rate hike campaign, perhaps overshot the mark, but raising rates, difficult environment, harder to make profits. And so the economy slows down, which is the reason they raise rates in the first place, and we move into a recession. But again, it's usually the result of what's already happened. To be moving into a recession and they haven't even really gotten started yet, scary thing there. So we'll see how that plays out. But I wanted to share those things with you. I know you're going to ask about gold, so let me show you that. And then I want to show you a case study that we closed out. Actually, I'm going to show you a couple of them that were really quick that we closed out for our alert subscribers. So you can see here, we had gold in this symmetrical triangle, had a bit of a false breakout. We told you that that means that's not a triangle, that we're having a larger triangle being formed here. And it looks like we have broken to the downside, even out of this larger triangle. So let's see if gold can find some support. At this point, it's broken underneath some potential support there at 175. The next level is massive support at 170. So if it breaks below 170, then it's going to 165. So we've got 5-point stair steps here on GLD. So with this breakdown again, going to try to hold 175. If it can't do it, we'll see 170. If it doesn't hold that, we'll see 165. That's what's going on in gold. So here's a couple case study quick alerts that we did last week. Both of them after last week's TradeFinder. Both of them lasted, look at that, 0 days. How can you have a trade that lasted 0 days? Was it a day trade? No, we don't do day trades. But what it means is that the alert opening was sent out and then the closing alert was sent out less than 24 hours from when the opening alert was sent out. So it wasn't at least 24 hours. That's why it shows 0 days here. But this was on Valero. And so this was a really nice trade, 34%. We kind of have a rule. If you can get 34% in a day, you take it. And so here are the particulars on the VLO position. Entry sent out on the 27th, exit on the 28th. And you can see the return there. And here was the chart. And we had this expectation of going up to the 161.8% level. And it all occurred the very next day. Look at that, right up to it the next day. So 1 day, all right, well, you want to do it in 1 day? Great, we'll take it. And we'll take over 30% in 1 day every single time. And so that's what occurred there. And then coming back and looking at PayPal. Now, this one was in the speculative portfolio. Notice Valero was in the impulse. That's the directionally based portfolio because that came from our impulse search. That was an expectation that we were going to have a continued wave 5 there up to that 161.8% extension. But PayPal was just a speculative trade based on the fact that PayPal was really oversold and we had divergence in one of our favored indicators. We like the DMI, we like the CCI, and we like the CMF, and we have created a technical trading system of those indicators to back up Elliott wave. So those are our confirming indicators that we use to support our Elliott wave analysis. So notice PayPal was going down, but the CCI, which is the shorter term, the DMI can be viewed as a bit of a lagging indicator, but the CCI is very responsive day to day. It was moving to the upside. So there you got positive divergence, the expectation, and there was an earnings report, right? So the expectation was that you're going to bounce higher, and that's what PayPal did. It bounced right back up on its earnings report and rectified that oversold condition going up to the 10-day moving average. And so we generated a nice gain. 18% could have been better, but a little bit of drop in volatility because of the earnings. We were out of the money, but they kind of hit the out of the money options a little bit now. I think we're part of the reason why we've been talking about trading out of the money options for 5 years now, and now they start to affect that with implied volatility. So we have our time strategy now to offset that. So, take a look at our time strategy. The whole one of the main ideas there is to offset the what they're doing, the market makers are doing. But anyway, so 2 trades there in a row, both on the same day, and both opened and closed in less than 24 hours. And they were both after last week's TradeFinder into the week. So we're still waiting on this breakout of USO out of its triangle. And here's a calendar spread that's working great here on Netflix, or excuse me, on Alcoa. Netflix is down here. We have a time strategy on it as well. And we're already up to 20% in 11 days on the time strategy. And that's the one I was telling you about that offsets that. So that gives you an idea of how our alert service works. This is the page where all our alerts are sent out. The difference between our alert service and TradeFinder is TradeFinder, we look for a case study consideration, and then you're on your own. And from that point in time, whatever happens, happens. And then we'll look for one tonight. Let's run through real quickly our previous one. So SIL was back on March 22nd. There's only a few of them here to look at. And you can see that we had a bit of a breakout to the upside, but the big move lower. And so if we go back to the midpoint here, I was at 36.5, the low down there around 32. So that's better than a 10% move. So I don't know if you're still in this triangle, if you wanted to try to turn around and move back to the upside. That's what we're doing due to the fact that we've got a ton of support right there. We've got a gap that needs to be filled up here. So we're looking for a bit of a bounce back to the upside in silver. Will gold help too? We'll wait and see. Now, Smuckers, we take a look at Smuckers. This is what we looked at last week. And then watch what's happened here. So Smuckers has moved lower, which means probably want to go ahead and close this position out. You could perhaps wait till tomorrow, see what happens with the market. Do we start to get a bit of a bounce? This is when the market is starting to show real cracks, when the positions that have been doing well are starting to fall. That's when you start to think, okay, maybe we want to consider closing this position out, taking a small loss. We haven't had many losses in our TradeFinder case study considerations if you were have been following along with them and used some sort of prudence on the exits. But there is resistance there at 145. It hit it, it held. Now we're at support at 135. So you could look at that and say, well, we're at support. Let's give it a try and see what happens in the market tomorrow. But if it doesn't hold 135, then it comes down to 130. So you need to be aware of that as far as whether or not you would want to hang in there with that one or not. ODP. So these we looked at last week. This was moving to the downside, was the expectation to come down here to the previous wave 4. That's the target price. And we have moved a bit lower, but we haven't quite hit that target price yet. So it has moved lower since last week, but I think that 42 level will actually get hit. Normally these Elliott wave Fibonacci levels get actually touched. It doesn't just come close. They actually get touched. So I think there's more downside to come here. And then Canada, we looked at Canada when we were going through and looking at our charts. And so looking at the Canadian market, you can see what we were looking at last week, thinking, okay, well, if you're going to put on a speculative trade and look for a bounce, this is as good as any of them because it's at massive support at 37. We got a little gap there at 38 and another gap about 39. So we're saying, hey, you could potentially get an oversold bounce here along with the 10-day moving average being the fact that we were significantly oversold. And look, we came up and we filled that gap at 38 and then we came back down and yesterday broke below 37, but no follow through day. Back above it today. So it's like, yikes, I'm holding on by the fingernails of 37. Don't want to lose that. Or you go down to 36 And so back up there, we still have this gap up here that needs to get filled. But as soon as we filled this first gap, we thought we'd get them both filled, but we filled that gap. We rectified the oversold condition. So we hit the 10-day moving average, filled the gap, and got a big reversal right back down. But holding 37. So if you wanted to hang in there, if you didn't exit on the bounce, if you wanted to hang in there, because we had talked about potentially moving up towards 39 where that gap is, that's something that you can consider. But you could have taken a quick gain as well on the oversold bounce and rectifying the 10-day moving average. So again, that's kind of up to you with the alert service. We send you out entry alerts, any adjustments and exits. So we kind of walk you from start to finish, where TradeFinder here, you're kind of on your own to figure things out from there. All right, so let's see if we can find a case study consideration for tonight. Kind of a tricky day going into that big Fed meeting tomorrow. But if we take a look, let's see, there are two bullish impulse results, Reliance Steel and LKQ. So let's look at Reliance Steel, RS, and it actually looks pretty darn good. It's in a wave 5, looks to extend to about 2. Well, we may have found one right off the bat here. Good volume today on today's move. That looks really good. And if we isolate the DMI, can see that it's supportive, good separation between the two directional indicators. Came down, so we're going for round 2. The wave 4 came down right at the 38.2% fib level with a doji. Does it get any better than that for a move back to the upside? And then we came up here. We broke to a new high above the wave 3. We tested it, broke back above it, tested it again here. So I think this is going to be our case study for moving forward from here. So let's just go ahead and write that in. So for today, we're going to look at Reliance Steel moving to the upside here with the target right there around 215. So I think don't have to look much further to see something that looks pretty good there. So we touched the 10-day moving average on the low. Again, we've broken above this. The DMI is suggestive that we continue higher. Positive money flow there. CCI looks good. Everything looks good on that one. So there you go. That was quick. There's our case study consideration for this week. A move to the upside up to 215 on RS. So that was quick. So we got a few extra minutes for questions this week, Zach. So let's go ahead and jump in. Usually there's only a few minutes at the end, but happy to go through a few.
Absolutely, and I'm sure everyone watching is happy with that as well. I will start out first with a question from Rick from Zoom. Can we take a look at KO this evening? Thanks, appreciate it.
Sure. Good old Coke. And so this is kind of what I was talking about as far as the drop in Smuckers, right? The food has been rock solid, and now we're starting to get a little bit of a dent even there. So it's like, where do you run to hide? Possibly the metals, because they've been beaten down. You just saw that chart on steel. Silver looks like it's turning around. Gold got hit pretty hard. So perhaps that's where money starts to move. Maybe the dollar weakens a little bit and that spurs it on. So we'll see. But down here to test 63. So, Coke is one of those stalwarts. Berkshire just had their big meeting over the weekend. You know how Buffett feels about it. So sitting here at 63 is your level of support. That's the line in the sand. We had 112% wave 5 extension, 61.8% wave 4. So really classic Elliott wave pattern. You could have been looking for potential to extend to 161.8. So far, it hasn't done that. But normally, when you have an extension, you come back and test the previous level, the previous fib level, before you move higher there. So let's go ahead and put this on. and we're pretty close to that, the 38.2% fib level here. So we're kind of right there where the wave 3 is. So testing that level before moving on to the next level is something that happens quite often. So we'll see if that plays out in Coke. But if it breaks this, then you've got a problem. So 63 right here at this major point of support. It's got the 50-day moving average as well. Not really that oversold from the 10-day moving average, maybe a tiny bit on the close, but sitting in there right at the 50-day moving average. So an added piece of support there. But you can see the movement that occurred here on the way up. So there's really nothing to stop it from going back to the wave 4. Now, if we follow Elliott wave rules, when you have a wave 5 that ends, so if that is the end, and it extended more than 100%, you come down to the 61.8% level, which could give you a potential low of 61 and change. So if it can't hold 63, that's where it's going, to the 61.22 level. So if you're long this, you want it to hold 63 and see if it can bounce. If you're short, then you want 63 to get broken, and then 61.20 is your likely target. And there's a bunch of support in that area there as well. So you can see all the support here right in this 61 area. But it's going to try to hold this because it was the wave 3 high. It's the 50-day moving average. We're a tiny bit oversold. It's going to try to hold 63, but that's what happens if it doesn't.
Awesome.
Okay.
Thanks, Rob. And transitioning over to YouTube, Constantine would like to ask, why do we need rates raised?
Why do we need rates raised? To stave off inflation. Because the Federal Reserve kept rates so low for so long. The way that you offset inflation is by raising rates. And because, this is my opinion, they kept monetary easing too long. And now we have massive inflation. Just hasn't really backed off a little bit. If inflation had backed off, the economy has, because the GDP was lower for the first quarter. But if inflation had backed off a little bit on the indicators, then perhaps we could have looked more towards a more dovish Fed. But the market isn't going to bother them. They don't care about moving the market lower. But if inflation had pulled in a little bit, then perhaps they would have been. But they're going to raise rates, and they're going to raise rates hard. It's on their watch. They've got egg on their face. They said inflation was transitory. They were wrong. And they're going to, by golly, they're going to get inflation down, and they're going to go hard to do it. And so that's why they're raising rates, to stave off inflation.
Awesome. Thanks, Rob. Back over to Zoom. Ray, excuse me, Ray asked, hi, Rob, can you please look at XHB? Is the CCI showing a divergence indicating a move up to the wave 4 price? Thanks very much, Ray from Melbourne.
Okay, Ray from Melbourne. All right. So looking here, you can see that we have support down there at 60. So that's what they're looking for, is a move back up to 70. You know, if that wave 5 is complete, that's what should happen, because it wasn't 100% extension. So it should go back up to 70. To see the home builders rally like that would be shocking to me, just because of the fact that rates are going up. Now, what usually happens is when rates go up, you get one last flush, right? Because there's been a bunch of people that have been waiting and waiting and waiting. And then when rates start going up, they're like, we can't wait any longer. Rates are going to go up. And if we're going to buy something, we need to do it now. And you get that last flush. And that's the last little blip on the radar screen. So that could be what generates the move up to 70. Is that you get a move up there as the last rush of people that want to get in before rates go significantly higher are making their move. Other than that, I would be surprised if it goes above 70, but that is the Elliott wave formula, is when a wave 5 ends, and you can see how long it's consolidated, so likely the end, and you start to bounce back up. We are back above the 10-day moving average. So the likelihood of going back up to that previous 4 is there. Not really much going on with the DMI. The CCI is that's where the divergence is the fact that it's rocketing to the upside here, and we had a little bit of a move up the last 2 days, but nothing too significant. So we're getting up in the area. We're not quite there yet, but we're getting up in the area of where we'd be in an extreme point with the CCI. But this is the same thing that we looked at with PayPal. Not quite the same. PayPal was moving lower while the CCI was moving up, but the CCI has been moving up while this is base. That's the launch pad effect that I've talked about. We used to talk about it when the market was moving to the upside, where you get some consolidation and then you get a big move higher. And perhaps that's exactly what occurs, because it does need to go up to satisfy the rule and hit that 70 level. We'll venture again and see if it can get there. That's the right direction that you want the CMF going. It's a little bit of divergence there, but it's more confirmation, because even though it's still red, it's important that people realize that red doesn't always mean down and green doesn't always mean up in the CMF. You're looking for confirmation and divergence out of that indicator. And the fact that it's sloping this direction, even though it's still red, and the security itself is moving up, is confirmation. So that's what you'd want. So yeah, Ray, I mean, as difficult as it might be to believe with rates going up, it does look like that wants to go satisfy that previous 4.
Alrighty, thanks, Rob. Next up, Doric from Zoom would like to look at ZW.
ZW?
Correct.
Z is in zebra?
Z is in zebra.
We don't have ZW. So I'm not sure what that is. Maybe guess the name. Maybe we can look it up.
Yeah, we'll come back to that one. Next up, Silver Miner from YouTube would like to look at XBI.
XBI. Biotechs. And, talking about where can money go and rotate, if food is getting hit now, then that's been hit pretty hard. Money is going to go find the areas that have been hit the hardest. So money's not going to rotate back into the areas that have been performing well. Money's going to rotate into areas that have been hit. Biotechs have been hit pretty hard. You can see the wave 5 there, and look at that doji today. So perfect doji, starting to get a little separation. This is a good one. The 10-day moving average and the 50-day moving average. So, the home builders perhaps on the wave 5 retracement, same thing here on the biotech. Now we got a little bit of a problem before we get all the way back up to the wave 4 on the XBI. We got to get back above 80, which was support. So now resistance, and then we've got more resistance that'll be at 90. And then we got to make it all the way back up towards 100 to get back to that wave 4. So some work to do here on the biotech index. The chart looked a little bit better on the home builders, but if it can get back above 80, we've got this separation here between the 10 and the 50-day moving averages as well, which is getting, you can see what happened last time that occurred. There was your rally there when you started to get this separation here between the 10 and the 50. And again, here where they separated a bit in a rally. So we could have a couple good ones there. The ones you've all asked to look at, both of those could be setting up for bounces, for decent bounces.
Awesome. Thanks, Rob. And coming back to Doric's question, I would like to look at wheat futures.
Okay. We can look at the futures or we can look at the ETF. So let's go ahead and look at the ETF, which is WEAT. Get it? So if we take the moving averages off, you can see that we're in a triangle here. I'll go ahead and bring up the futures too, but there's a triangle there on wheat. So we're about to have something happen. Is it going to come all the way back down? Maybe. We had that vertical move up and then we came vertically back down and then we consolidated. And this is my favorite breakout pattern when you have a vertical move and a symmetrical consolidation. It's going to go. Wheat's going to go somewhere. We all hope it doesn't break back to the upside, right? Because we know what that means for food prices, etc. Perhaps it comes back down and we get some relief there and we come back down to support around here. But man, another break to the upside would not be great. So there's wheat, and you can see the same chart. So the ETF mirroring what's going on with the futures, spot on. Get it? Futures spot. Anyway, some of you probably got that. Poor humor, poor attempt at humor. But anyway, yeah, good. Something's getting ready to happen with wheat. I can't tell you which way it's going to go, but there's going to be a significant move. Great looking 5-wave impulse pattern. Again, Elliott would say it's likely to break higher. I hope that scenario is wrong and it breaks lower, but it looks like it wants to go.
Thanks, Rob. And just so you're aware, you did get some last from the chat box. So.
Okay, good.
Next up, Manuel from YouTube would like to look at AMD.
Oh yeah, after hours earnings report, and going to see a whole different chart tomorrow on AMD. I believe it was up like $7 last I looked. Just destroyed their earnings report, just blew it out of the water. And so yeah, we're going to be back up testing this 100 area tomorrow if everything holds through. Let me see what it looks like. Give you the current price. Yeah, so we're right under 100, and after hours 98.79 was the high. So then you start thinking, okay, well, that's not really looking forward, right, to economic weakness from the Federal Reserve raising rates so significantly. That's the previous quarter. Can it break above 100? If it can break above 100, then we have something interesting, because we're probably going to 120. If it breaks above 100, then the next level of resistance is there at 120, which is right in that wave 4 forecasted tap box. If the wave 4 were to begin today, remember that doesn't tell you that the wave 4 is underway. It says if the wave 4 were to start today, that's where you could find some resistance, and it happens to be right at a resistance area of 120. But yeah, we're going to be right here around 100 tomorrow, and how it handles 100 is going to tell the story. If it can climb above it, then you probably see 120. But fantastic earnings report after hours on AMD. I understand why someone wanted to look at that.
Yes, indeed. John from Zoom would like to look at JWN.
JWN. And this was asked on YouTube, so here we go. On the last recording, he was asked to look at JWN. I promised to do it tonight, so here we are. And that looks like a great butterfly to me, because we're just dead sideways here in the middle of pretty significant support and resistance. We did this on a time strategy trade that had the exact same type of chart, where it was trading in between two gaps. So you got the gap down there and you got the gap up here, and then you're right in between the two. Works out really well for a butterfly as it tries to figure out which gap is going to go fill first. Now, the only issue is it's been going sideways for a couple months. And that's the thing with going sideways, right? Our time strategy, we have the AI telling us how much longer it's expected to go, or if it's expected to go for the next 21 plus days, which is what 21 days average is what we look at for our time strategy. So we know that there's a likelihood it does that. Is this going to go sideways for another 21 days? Very likely, I think, based on, the same, almost a very similar pattern that we had before with our time strategy. So in between gaps like this, and you also have resistance at 30, support at 24. So just a 24, 27, 30 butterfly makes a lot of sense to me as it bounces back around in there. As far as there's no 5-wave impulse pattern, so it's all corrective stuff that's occurring right now. And this looks like a big flat to me. So there's your A, and I think we're forming the B in the flat. Could come all the way down to 24, as you know, in a flat. Doesn't have to, but it could come down there. A little bit of a doji on the chart today, but at least for now, that makes a lot of sense. It's not, let's look at where the ADX is. Yeah, it's not low enough. So the ADX is actually high enough to say that we could stay sideways for a while longer. It's not low enough to say that a breakout is imminent. So I don't know. I think a butterfly right in those wings makes a lot of sense. I'd looked at this one when it was asked on YouTube too. So I felt the same way then as do now. So.
Agreed, and thanks for that insight, Rob. Elon from YouTube would like to look at SoFi.
Elon, huh?
Not sure if it's him. But
well, SoFi has gotten its you know what handed to it on this move lower, zigzagging all the way down, and we're at 100%, and it's trying to hold right here. So if this is going to hold, it's going to do it here. We're right above 5, so technically it could go down a little bit lower. Institutions, you know, the 5 and 10 rule. If you haven't, let me go through it real quick. When stocks can only be owned, they're on the pink sheets until they get above 5, and then at 5, then you can go to aggressive minded institutions can trade stocks at $5, and then it goes up to 10. And if the stock goes above 10, then growth institutions, growth and income. So if their investment objective is growth, then they can own $10 and above stocks. But only if they're aggressive investment objective can they own them between 5 and 10. So if it's institutionally owned, which it likely is because it's been way up around 25, then the institutions will come in and support it, because if it breaks below 5, then they have to sell, and then they have to realize the loss. And they'd rather see if they can initiate some short covering by coming in and buying and seeing if that spurs the price higher, which works a lot. And it's trying to hold right here at the 100% extension rather than down at 5. So it's trying to give them a little bit of a buffer and hold here. So if you wanted to take a real speculative shot in the dark of holding here, you could do that. If it breaks 6, it's going to 5 though, but you have another layer of support at 5. So if you're willing to weather that, you could. But being right at 100% extension is a point where it's trying to hold. And the $6 level, you can see, have been going sideways for going on 2 weeks now. Now, if it breaks higher, you have some room until it gets up to 8, and then it's going to have some resistance there at 8. And if it breaks 8, it's got even more at 9. But you could get a little bit of a bounce here. Nothing really significant there. There's some positive news there out of the CCI telling you that you could get a move there, getting same thing here. So you're getting some signs that this may want to try a bounce. So again, it'd be very speculative, but if you want to try something speculative, you could come in at 6 and look for a move to 8 and see what happens at that point. And then if it gets to 8, then reevaluate and see what happens there. As a reminder, though, if it breaks 6, it's going to 5, and it could find some support there.
Awesome. Thanks, Rob. We are 3 minutes after the hour. So as always, you tell me.
We'll do one more. Wow, that time went fast. When you had extra time, it just goes so quick.
Yes, indeed. All right, we'll finish with this last one from Brian from Zoom. RKT. Thanks very much.
RKT. Rocket makes sense. Well, you know, it's got a little bit of a launch pad. Could it have the launch pad effect here? Oh, it has tough attempts at humor tonight. But so sitting here at 9, there's a pretty significant move to the upside. The problem being we have resistance right here at 10. But again, it's been higher. So there's a lot of institutions that own this. Wow, there's crazy moves back there. So it could get some added support. If it comes back above 10, then perhaps some of those institutions that were thinking they may have to realize the loss could step in and give it a little bit more, give it like another nudge. And you could potentially see a move up to 13 before it finds a little bit of resistance. But it's got to get above 10, and then it'll bump its head at 11 a little bit. But that's where I'm thinking that if it can get above 10, it probably gets some more institutional support, and that could blow it above 11, which gets it to 13 in a very short period of time. But right now, it's got to get back above 10. It's pushing it now. I don't remember the number of days. I used to know it, but how long it can trade below that level of 10 or 5 before you have to sell and realize the loss. But it's pushing it. It's been there for a while, but it made a nice move today. See if there's some volume on that. Not really. See, that was a move. That was a lack of sellers today rather than buyers, but impulse moves sometimes start that way. So if it can get some follow through tomorrow, it did close above the 10-day moving average, which that was good. If it can get above 10, then you got something going there. But for me, I would, even from a speculative standpoint, I would want to see it get above 10, and then you could take a shot at it, because you could get a quick run to 13, which would be really nice, right? If it does that. So thanks everybody. It was great to get a few extra questions in from the viewers than we normally do on TradeFinder. And as always, time's most valuable asset we all have. We appreciate very much you devoting some of your valuable time to us. We try to make it an informative and educational use of your time. Thanks, everybody. Watch tomorrow. Tomorrow's going to be wild, I think, and possibly into Thursday as well. So